Mike Tedeschi, Wealth Management Advisor, Perspective Wealth Planning, with this week's market breakdown video. We're going to take a look at the four major U.S. indexes, the U.S. dollar. We're going to take a look at some commodities. What we're really going to discuss in depth in today's video is we are going to take a look at breadth readings and sentiment, because we are at a crossroads here. We are seeing breadth expansion across the board, not just in the U.S., but globally, and this historically has preceded some fantastic bull markets and continued expansion. But at the same point in time, our sentiment readings are at a level that typically tends to precede large corrections. So we have our breadth readings and our sentiment readings, and they are telling us the exact opposite here. And so we really want to pay attention to what exactly is going on and discuss what that could mean for us moving forward. Now, before we get into that, let's talk about the technicals. Technicals markets still look extremely solid. We've been talking about this for quite some time. The S&P 500 broke out, made that new all-time high there at the end of November, beginning of December, and has just grinded higher since. We're up about 2.5% so far for the year on the S&P 500, and continuing our grind higher. We take a look at the NASDAQ. The NASDAQ really took a leadership role once again here this week. We saw some of the large cap tech companies really start to take off, which is the first time they've kind of done that for a while. Some of the larger names hadn't made new highs in the last 6 months. They started to make those pushes to the upside this last week. And we saw the Russell start to kind of see a little bit of capital outflows. Okay, so while the tech started once again ramping up, we saw those mid and those small caps kind of fall back down a little bit. So this could once again be that healthy rotation. We had rotated into those mid and small caps here for the last couple of months and had a crazy expansion to the upside from breaking out to those new all-time highs at 1750. And we saw kind of tech kind of stall out, the big tech names kind of stall out at that point. So we might be seeing rotation back to where we were before. We'll continue to pay attention and see how that goes. Now the Dow, as you can see right in here, right, has made its continued grind higher and did just marginally make a new all-time high yesterday. It's been fighting right around that 31,000 level, since the beginning of this year. So a little bit weaker than some of the other indexes. That's kind of been the case here for a while. It's been kind of a lagger. But still pushing up near those highs, all those all-time highs. So that's looking pretty solid. We take a look in at the emerging markets. The emerging markets have just continued to just be absolute monsters here. We nailed this down. We've talked very much about this here over the last few months, and we're finally seeing that kind of global expansion across the board, where we're seeing the emerging markets really starting to see inflows and a really strong start to the year. Right, so the S&P 500 is up a couple percent from the close of the year last year to where we are right now. The emerging markets are up almost 10%. So really strong performance globally here. Now, part of the reason has to do with the U.S. dollar. Now, the U.S. dollar, interestingly enough, fell at the beginning of the year and subsequently made a bounce off of this key level right around that 89.50 zone, but was not able to get back up over that 91. So if we look at this from a technical standpoint, we still have lower highs and lower lows at the moment. Right? So for this trend to change, the dollar needs to get up over that 91 and take this kind of zone out right here. And for the trend to continue, we need to take this low out. And again, when we look at this on a monthly time frame, this area right here is 10-year, 15-year support, going all the way down to about that 87.5 zone. Right, we've been paying very close attention to this for about 6 months. We've kind of stalled out here, and in the beginning of the year started to make a potential bounce. We do not have a trend change. We have not changed anything with this chart on a mid to long-term time frame. It's just something worth noting that we couldn't break below this and hold below that. But we haven't pushed back up. So those are the key levels we're watching. Over 91, under 89.50. And that's going to have, again, profound implications for commodities. And we've talked about those for quite some time. Now let's take a look in at oil here. We'll start with the oil. These are all the lines that we've got on the chart. We've talked about them. These are those resistance points. We have resistance right up here around 54. That's what we've run into. We started to turn back a little bit from it. There's nothing wrong with this chart. Still in an uptrend. We still have higher highs and higher lows. Right? A move back underneath 49 would change this chart. But as it sits right now, we're just slowly grinding higher. That's where that has been. We saw some incredible moves out of the soft commodities. Corn having an explosive move higher, limit up, kind of pulled back, closed that gap, but still a very, very strong chart at this point in time. When we take a look at wheat, also holding over the breakout spot there at 640, so still a very strong looking chart there. When we come in and we take a look at copper, copper's still holding up in that high tight flag over that 350, holding that major breakout. Platinum actually had a nice move, held up over that 1050 zone. I'm going to back this out into a monthly chart. You can see our next resistance zone on platinum is about that 1200 level. We come in here, we take a look at palladium, which really still has not done anything in terms of getting over that 2,500 in a while. Really a 2,100 to 2,500 range for the last 6 months, continuing to watch how that ultimately is going to get resolved. We take a look at silver. Silver pushed all the way up to 28. You know, it's been between that 22 and 28 for about 6 months, hanging out in the middle of that range right around that 25 level. Gold, as we know, a little bit weaker than silver here, pushing more towards the bottom end of its range, still holding over its major breakout level, which really is at 1750 to 1800-ish level. But no appreciation really in the price of gold here in the last 6 months either. So there's a lot of time where these precious metals have been running sideways here. We're going to have to pay attention and continue to watch these and see if they're going to make a continuation move here to the upside at some point in the future, or if the giant move that we had last year is really going to cool off here for quite some time. So we're going to continue to pay attention to that. Let's jump in here and take a look at our smart money, dumb money confidence indicator. The dumb money is really, really confident. We're back up in the high 80s, while the smart money is back in those lower 20s. Now, as we know, this can continue for quite some time, but usually when these things change directions, we ultimately get that crossover, and that's where we kind of get that pullback in the overall market. So this is stretched. And continue to stay stretched, but when it starts to fall back down, that's where we need to really pay close attention to what's going on. Now, when we start talking about euphoria here, the NASDAQ, after it's had a greater than 0.5% gain to a record high with more than 45% of its holdings are on the upward movement here, has not bode well for the markets in the long term in the past. We only have a couple of these readings, and they happened late in the 90s, and they happened right before we had that kind of turnover there in 2015 or so. And now we're getting a cluster of these readings over the last few months. Now, if we look at a 1 year later, and again, the only times this happened in the past all preceded large drops in the market over the next year. You have a 0% win rate with a 32% average down draw. Now, part of the reason why we could see numbers like this is you have a move to the upside, which is a strong move, and then you have a large continuation at the end of a move. That's that kind of exhaustion gap, and then things kind of can roll over. That's what this particular data set's telling us. So when we see something like this, we see the dumb money, smart money confidence, we look at this and we go, man, we could be nearing that turning point. It doesn't mean we do anything different. It doesn't mean we start taking chips off the table because we get all worried. It just gives us word of caution. But when we compare this to the breadth readings that we're seeing, we get a very, very different picture. When we take a look at the world index, the percentage of countries that are in a correction is less than 20% for the first time in 9 months, going back over the last 30 years. This bodes very, very well for the markets. 6 months later, they're positive 100% of the time. A year later, they're positive 90% of the time. 2 years, 80% of the time. 3 years later, 90% of the time. This is a very, very solid bullish case, because this is a robust breadth expansion, and you usually do not see markets roll over on breadth expansion. Markets typically tend to roll over when underneath the surface the breadth is deteriorating and only kind of a few names are holding things up, and then everything kind of rolls over together. That's typically how that cycle works. So when we see breadth readings like this, everything looks very positive for the long-term future. Now let's jump back and take a look at what happens to small caps in that same environment. Look at these numbers: 6 months, 9 months, 1 year, 2 years, 3 years out. Almost 100% of the time, they're positive, right? Risk appetite has risen, and people are really starting to take advantage of that breadth. Value stocks have done extremely well in that environment. 1 year, 2 year, 3 years out, again, 100, 190% positive with a number of readings over the last 30 years, right? We are seeing right now really, really good breadth expansion, and it's a positive for the long term. The last way that we'll take a look at it is the New York Stock Exchange breadth, percentage of stocks over their 200-day moving average. Look at the reading that we're at over here, right? If we look at the markets 2 months later, 3 months later, 6 months later, and a year later, it is a very high positive percentage, right? We are seeing breadth expansion across the board, not just in the U.S., but globally. That is a very, very bullish thing. We take a look at the indexes themselves. They're trading up near those all-time highs, making new all-time highs on a regular basis. The negative component that we have to this entire picture is that we are very much in a euphoric market, and that typically has preceded some large pullbacks over the years. But until the market starts showing us weakness, until we start seeing breadth deteriorate underneath of the surface, we have to go with what the charts are telling us. And when I pull up a chart here of the S&P 500, and I see this breakout to new all-time highs and grind higher, price is telling us things look good. Price is telling us things look good in the emerging markets. Price is telling us things look good at this moment. We have to keep in the back of our minds that there may be some cracks in that foundation, but they haven't started to show yet. But we just need to keep in mind the possibilities moving forward, and we will continue to, in these videos, really take a look at all of those different components and discuss all of these different things and what those outcomes can ultimately mean for us moving forward. But as it sits right now, let's go with what price is telling us, let's go with what these charts are telling us, and let's go with what these breadth readings are telling us. And just keep in the back of our mind that idea that we may have to pivot at some point in the future. As always, if you guys want to reach out to me directly, you're more than welcome to. I'm happy to talk about anything related to the markets. Tedeschi at PerspectiveWealthPlanning.com, or give me a call at 814-580-9881. Look forward to talking to you guys. As always, I hope you found this video and the information in it useful. If you have, please subscribe to our channel so you can see these on a regular basis. I will see you guys next week. Take care.